Hi, wonderful learners. How are you guys doing? For the viewers, hope you guys have been getting a thing or two from this YouTube channel. And for new viewers, how are you all doing today? My name is Godwin. So welcome back to MOG, or welcome, as the case may be, to MOG Economics YouTube channel. Um, Recently we started talking about national income accounting, like talking about it again after a couple of years that we left it alone, right? So we are reintroducing it in a simpler way. And then in the previous lesson, I was mentioning that we start solving exercises on national income accounting. All right. So this is our first exercise of several, and the exercises solved in this particular series are actually examination questions of students in like in universities, or textbook solved exercises from and examples from various textbooks, like pretty nice textbooks. So the question says, in a simple economy where there are no indirect taxes, that is, you don't have tax on goods and services, given the data below, calculate the national income using the income method, which was what we learned in the last lesson, and B, calculate the GDP using both the income method and the expenditure method. Right, so EXP is expenditure. I shortened it due to space. So we have a couple of items like in millions of naira. So you have consumption, which is 5,000 million, that's 5 billion. Investments, 1,000 million, which is 1 billion. Then you have depreciation, profits, exports, employee compensation. So COMP is compensation, employee compensation, government purchases, direct taxes, saving, and imports, and their corresponding values. All right, so this is a one of the ways you can get questions on this particular topic. A lot of items, and you are not necessarily going to need all of the items to solve each question that you have. So the understanding of national income accounting and the items you're meant to add somewhere or remove somewhere are going to give you an idea of how to approach every question that you have. Okay, so here we'll be looking at the first summary series calculate the national income using the income approach. Recall that I told you that by the time you add up all of your items using the income approach, what you're going to get is your. Thank you, somebody just said it. I like that. So, what you're going to get is your NDP at factor cost. But your national income is actually NNP at factor cost. All right, so what do we do to get NDP at factor cost? What are rewards to the factors of production from what we have here? Consumption, nah. Investment, nope. Depreciation, nah. We have profit. Profit is the reward for enterprise. So we are picking profit. So we have profit. And let's see if there's another item plus um exports. Nope. Employee compensation. Yeah, that's reward for labor. Plus let me just write EMP. Employee compensation. Please, in an examination, you have to write it in full. Like you don't just jump into adding the numbers. Like you need to write something like this, right? So like let them know the items that you picked and summed up to get a particular answer. Please, please. Okay. All right. So what else is a reward factors of product? Government purchases? Nope. Direct taxes? None of our business. Saving? No. Import? No. So we only have two reward for factors of production that we can add up. So from there, equal to profit is 1, 2, 3, 4, 1, 2, 3, 4. Profit is 900 plus employee compensation is 5,300. 5,300. So our NDP at factor cost is 600, 200, 6,200 million. All right. Um, 1, 2, 3, 1, 2, 3. All right. After that, how then do we get our NNP? Because that's what we need. So NNP at factor cost is going to be equal to NDP at factor cost plus net factor income from abroad. And if you remember from previous lesson, I said that is income received from abroad minus income paid to foreigners. So you could have each of those items like that, or property income from abroad, property income to foreigners to find the net. Or you may just have net income like from abroad among your list of items. So, but then if you look at this, we don't have anything that looks like net factor income, whether the family name or the family members, nothing. So, in this case, NNP FC is equal to 6,200 million plus zero, and this is still going to give us let me just do something like this. 6,200 naira million. We must leave it like that. That's the unit of the question anyway. So we are done. This is our national income. So because we were not given any other thing that we could have put here, so don't bring in something that is not there, right? Don't manufacture data. Now that's that about question A. So for question B, it says um, we should calculate what do you call it? GDP using the income and expenditure approach. Okay, so how do you get GDP? Right? So I think the easiest way to get GDP is using the expenditure approach actually. So uh for B, let me just call it BI. So the expenditure approach. So you have GDP. Okay, let me just leave it like this. GDP at market price equals to C plus I plus G plus NX. So where C is consumption, private domestic consumption, I is gross investment, G is government spending, NS is net export, which is same as export minus import. So I want to believe that you're very familiar with this. So of course, before even getting into the income approach, you would have been taught expenditure approach. Okay. So what you just need to know is that using the income approach, when you sum your incomes, you are getting NDP as factor cost. But using the expenditure approach, you are going to be getting GDP at market price. GDP at market price. So let's find out what our GDP at market price is. So this is going to be equal to consumption. Do we have that? 5,000. 5,000 plus your investments must be gross investment, right? So if you have investment like this, it is also gross investment. When you have net investment in front of it, you must convert net investments to gross investment. If you don't do that, your answer is going to be wrong. So 5,000 plus investments is like this, so 1,000 plus what's government spending? Government spending same as government purchases, 1,000. Then plus NX. Okay, let me just do plus export minus imports. So export, do we have exports? Export is 500 minus imports is 700. So by the time you do all of this, you're going to get 6,800. Then, so this is the GDP at market price. So what we have to do is we have to calculate our GDP at market price as well using the income approach and see if we're going to arrive at 6,800. Now this is NNP, right? So how do we get GDP now that we have NNP? Okay, so I think net, you have to subtract depreciation from gross to get net. So this one, GNP first, GNP at factor cost is equal to NNP at factor cost plus depreciation, right? But GNP on its own actually is GDP. This one is GDP at factor costs plus net income from abroad, NFIA, right? And that is equal to NNPFC plus depreciation. Right, so when you add net factor income from abroad to your GDP, you are going to get your GNP. So from this, maybe I should use this marker. So from this GDPFC equals to all of this NNPFC plus depreciation, then minus NFIA, net factor income from abroad. All right, but what we are looking for is GDP at market price. From factor cost, like I said in the previous video, is just looking at rewards paid to, all other factors of production used in the production of goods and services. But market price is already talking about when the output was sold, when people have started paying indirect taxes on it. So what you're going to do is for us to convert factor cost to market price, you know that there is no indirect tax yet, right? So you're going to add indirect taxes to the value of your factor cost. you are going to subtract subsidies. Subsidy that is already part that government paid, that was also part of what do you call it, cost of production. So you have to subtract subsidies from it. So these things you'll be like getting them like one by one, like small, small. All right. So GDP. When we are done getting this, so our GDP at market price will be equal to GDP at factor cost, GDP at factor cost, plus indirect taxes, indirect taxes, then minus subsidy, indirect taxes minus subsidy. So indirect taxes minus subsidy is also known as net indirect taxes. That is this minus this is also known as net indirect taxes. So because sometimes in your list of items you'll be given net indirect taxes. So that means subsidy has already been deducted from indirect taxes. So the more you play with questions on national income, the more you're going to understand national income. I think we can just proceed. GDP, let me erase this. So yeah, I said net, there's something called net indirect taxes, and this is equal to indirect taxes minus subsidy. So this what you have there. So GDP at market price, GDP at market price, GDP at market price using the income approach is going to give us it's going to give us, where is it? GDPFC. So GDPFC is NNPFC plus depreciation minus NFIA. Alright, so NNPFC, which is here, what that one give us 6,200. So you have 6,200. I'm just trying to like calculate GDP FC from what we already have here. So GDP FC is here. So 6,200 plus depreciation. Where is depreciation? 600 plus 600. Where is GDP FC again? Then minus NFIA, minus zero. We don't have NFIA. Minus zero. So that's the GDPFC here is equal to like this formula. So I just use this formula like in place of this person. So this is GDP, this is GDPFC, then plus indirect taxes. The question said we don't have indirect taxes, so there are no net indirect taxes. So plus zero minus zero. So GDP MP equals to 6,800 as well. Naira million. So we can see that with the income and expenditure approach, both results are the same, right? So which is actually what it's supposed to be. All of the three approaches should yield the same answer under normal circumstances. If they don't, then you use statistical discrepancy to correct the error, that's occurring between or among them. Yeah, so we are done with this particular question. So next video we move to a different exercise, about 2 or 3 more exercises, different variations, different versions once we get this thing right. Thank you for watching. See you in lessons.